Let me tell you why companies use financial statements. In the past, companies used household account books just like individuals. But at some point, companies started using a different method. Now let's find out how household accounting and corporate accounting are different. My salary is $4,000. I also borrowed $1,000 from the bank. My monthly cash income is $5,000. I spent $2,500 on living expenses. I also saved $500. Cash expenditures per month are $3,000. Oh, I almost forgot. I also spent $300 on drinks on credit. It's my favorite bar. I have to pay it back later. I might forget this again, so I should write it down somewhere. I have $2,000 cash left. This is how the household account book is made. How much profit did you make in a month? The household account book can't answer that question because it was made mainly for cash. Even cashless transactions are managed with Post-it notes. This is how corporate accounting is created. We call it revenue instead of cash income. Borrowing is not something I earned. It's called debt because you have to pay it back someday. Revenue should be calculated as $4,000. We call it an expense instead of cash expenditures. I didn't spend my savings. You can get it back later. Even if it's a credit transaction, it's the expense. The expenses should be calculated as $2,800. If you subtract $2,800 in expenses from $4,000 in revenue, you're left with a profit of $1,200. $2,000 cash is mine. That's $2,500 including savings. We call this an asset. The amount I have to repay from now on is $100 to $300 including alcohol costs. We call it liabilities. Assets minus liabilities are called equity. It's $1,200. This is how the income statement and balance sheet used by companies are created. Household accounting and corporate accounting are very different.